So the simplest way to think of an auto call is like a bond that pays income and returns your principal at par as long as an equity underlying doesn't fall too far.
All right, joining me will be David Mann, head of ETF Product and Capital Markets at Franklin Templeton, who now has nearly $40 billion in U.S. ETF assets. That's across 74 ETFs. And of course, Franklin Templeton overall, we're talking about a nearly $1.7 trillion asset manager. But in terms of their ETF business, it has been a very strong year thus far. Already about $10 billion in inflows into their US listed ETFs. That includes products such as the Franklin International Low Volatility High Dividend ETF, ticker LVHI, the Putnam Focused Large Cap Value ETF, ticker PVAL. Those two alone have brought in several $billion combined. And as I was looking at the ETF lineup overall for Franklin, I'll tell you, it's an interesting one. It spans both active and passive strategies. They have country-specific ETFs, several flavors of fixed income ETFs. They do have a spot Bitcoin and spot Ether ETF, also a crypto index ETF. It's a broad and unique ETF lineup. And so David and I are going to look at a handful of those ETFs. And we're also just going to discuss the growth of their ETF business overall, which is part of that. I'm going to weave in a few broader ETF topics, such as the multi-share class structure and where there's still white space in the industry, crypto. I think all of these could play into how Franklin might position for growth moving forward. So David will join me here in just a moment. And then later, I will be joined by Matt Kaufman, head of ETFs at Calamos. And I think everybody knows I love first in the ETF space. I love ETF innovation. And back in June, Calamos debuted the first Autocallable ETF, an Autocallable ETF. It's called the Calamos Autocallable Income ETF, ticker CAIE. And if you don't know what Autocallables are, don't worry, because we are going to go in depth on those. We'll make sure you understand them inside and out, their potential benefits, their potential risks, and why you may want to own them in an ETF wrapper. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. All right, let me now welcome in David Mann, head of ETF Product and Capital Markets at Franklin Templeton, who again, Franklin has had a very productive 2025 in the ETF space. David, always a pleasure. Thank you for joining me.
Thanks for having me, Nate.
You know, it's interesting. In the back half of last year, I saw that Franklin Templeton actually set a public goal of reaching $50 billion in global ETF assets by the end of 2025. As I understand it, you're now about there, right? With a little time to spare.
We hit it last week, so a lot of celebratory emails going around. So yeah, we got there.
Well, congratulations. And I believe at the time the goal was set, I was looking back, your global assets were a little over $30 billion. So we're talking about a sizable jump here over the past year or so. And I certainly want to get into some specific ETFs in a moment, but just at a higher level, what do you attribute that growth to? What have been some of the drivers?
Yeah, sure. Thanks, Nate. And you're right. Like I think a year ago we were a little over 30 billion, and 2 years ago I think we were in the high teens. So, you put these big numbers out there like 50, and then you get there, and of course I think the next day we were already talking about 100 billion. So don't give us at least a week to celebrate. But yeah, I mean, it's hard to believe I've been here almost 10 years now, and it was interesting that don't need to go through the entire history lesson, but we started with smart beta, which was a very common starting point for active managers. We launched a suite of passive funds, so single country and regional exposures. But then we were also, kind of the bread and butter of Franklin Templeton was active ETFs. And so we really wanted to start launching a full suite of funds that would highlight a lot of the best capabilities of Franklin Templeton, knowing that those actually might take some time to build track records, get client adoption, start screening properly. So, I don't know if 3 pillars is the official way I would think about those, but we ended up with smart beta, index, and active strategies. And all 3 of those have really been growing nicely together. So it kind of gives us a nice broad, lineup to some investors want passive. We can talk with them about passive who just want exposure to a market, and others want rules-based index or active management. We can have that conversation as well.
In terms of specific ETFs, I mentioned those two at the top, the Franklin International Low Volatility High Dividend ETF, ticker LVHI, and the Putnam Focused Large Cap Value ETF, ticker PVAL. Those have been leading the firm in inflows. Though I know you've also seen really strong inflows into the Franklin FTSE India ETF, ticker FLIN. There are several fixed income ETFs that have seen strong inflows. Any in particular you like to highlight here while we're talking about the growth of the firm overall?
No, so you hit the largest asset gatherers for us. So I guess first, just before diving into the specific funds, is the last few years have really been a boon for active ETFs within the U.S. So I think out of the now over $1 trillion of net inflows, it's been pretty consistent over the last 3 months or so. 37%, almost on the screws, have gone into active strategies. So as active ETFs grow, we can start highlighting some of those specific funds that we think will shine. The first one, PVAL, that you mentioned, the Putnam Focused Large Cap Value. I think we've had a little under $3 billion of net inflows this year. That is a value strategy, and it really screens nicely across the against the big benchmarks. I think since inception, north of 500 or 600 basis points of outperformance. So it's actually a pretty easy conversation to have to show how well that team is picking their value stocks. Before going to some of those other ones on the active front, INCM, that's the Franklin Income Focus ETF. That's a multi-asset class ETF run by the Franklin Income Investors team. So that's the same team that runs the Franklin Income strategy. That fund is about $500 million of net inflows and also getting close to $1 billion of AUM. Once again, it's easy to say, hey, we have this team with 75 years of history. You had it in a mutual fund form, you had it in SMA form, and now we have that in ETF form as well. And then, the other ones you mentioned, when we provided the single country suite, we had a feeling that investors would want target exposure to specific countries. And this year, India, part economic growth, part the demographics. It's been a nice story. That's added almost $1 billion of net inflows, but we have other single country funds like our Japan and UK that are also either well over $1 billion or on their way.
Going back to your comments just on the rise of active management, the rise of active ETFs, it's funny, I think I've asked every single guest on ETF Prime who offers active products what they attribute the rise of active ETFs to. So I'll ask you the same question. I know listeners have heard a variety of responses. I'm just curious, what, if you were to boil it down, what do you attribute the rise of active ETFs to?
I mean, the main answer is, how's that fund doing against its benchmark? I mean, if it's performing well and it's providing risk-adjusted returns and it's providing benefits, whether alpha or risk-adjusted returns, investors are going to be that they're going to want to pick that one, even if the management fee is slightly higher than some of the benchmarks. I'd be remiss if I didn't mention the regulatory changes over the last, call it, half decade that sort of codified that active ETFs and index ETFs within the ETF vehicle were the same. That was a big deal because that was sort of that made all the transparency and liquidity kind of like for like. So then we could actually start talking about the portfolio. So I would call it 2 parts or 3 parts. You have to perform properly, and then the rest is that regulatory stamp of approval that came a few years ago.
Again, as I was going through the Franklin ETF lineup, I saw that you've had several new launches this year. So back in August, Franklin launched a dividend growth ETF, ticker FRIZ, along with a multi-sector income ETF, ticker MULT. Both of those are actively managed. Again, Franklin offers a number of active products. But I'm curious, what do those launches tell us about where Franklin is viewing opportunities right now? Because you also launched a couple of dividend multiplier ETFs in January. So those were index-based, but there definitely seems to be a focus on dividends and income. So what does that tell us?
Right. So the specifically for the dividend growth fund, ticker FRIZ, that is from the same team that runs the Franklin Rising Dividend Strategy. So back to sort of the the high level concept of bringing the best of our capabilities into the ETF form. That's the conversation we're having with all the investment teams at Franklin Templeton. So ones that we've had actually pretty significant and lengthy talks for a while now. I think everyone's seeing the same growth into the active ETF space that I highlighted a few minutes ago. And so we're now trying to find gaps in our lineup that we think could fit nicely with those investment teams. FRIZ was one of those. The two index funds that you mentioned, those are co-developed with clients. So that's another conversation that we'll always happily have for the right opportunities. But specifically right now, if you look at what's in our pipeline coming up, it really is leaning on that active expertise within Franklin Templeton.
Yeah, and on that note, so obviously you want to offer your best capabilities where investors want them, which increasingly is, of course, the ETF wrapper. But I'm curious, how much does the market environment play into Franklin's strategy around ETF launches? Like, how do you think about that? Because it can obviously take some time to bring an ETF from the idea stage to inception. And as we all know, markets can move extremely quickly, but there's clearly opportunity here as well. If, say, you believe, I don't know, international equities will be a longer term outperformer, or perhaps the rate environment will change substantially, you want to make sure you have the right solutions available on the market for investors. So just at a high level, how do you think about that?
Yeah, I mean, I think you actually summarized that perfectly, where we want to have a broad lineup of options for investors across stocks, across bonds, across domestic equities, against international equities, against emerging market equities, high yield bonds. We have bank loan, et cetera. Because you're right, we don't know what particular asset class will be in favor at that particular time, and so we try to be very thoughtful to give that whole menu and then focus accordingly when market conditions present themselves. Earlier you mentioned LVHI. I think that's added about $1.5 billion this year. That's a low vol, high div international equity fund, and international equities managed for volatility was a very nice story to have this year, as international equities have really shined nicely. So you said it right. I mean, we can look at Morningstar style boxes. We can look at sort of broad buckets. We have that conversation all the time. Sometimes we'll have funds in the same bucket through different investment teams. Franklin Templeton, Clearbridge and Putnam, Franklin Equity, these are investment teams within Franklin Templeton. So we'll talk with all of them. They might have a slightly different philosophy about getting exposure to growth stocks or international equities, and we'll try to be thoughtful about what we bring to market next.
So in the context of Franklin's product development, actually, I think this is a good segue here to talk about Franklin's ETF growth strategy moving forward, because you set this ambitious goal for 2025. You hit it pretty easily. I'm holding you to the 100 billion mark now in 2026, but clearly you see opportunity moving forward. So how do you continue to drive that growth?
Yeah. Well, the 100 billion was really supposed to be by 27, but if you're moving it up a year, maybe you've been talking to the executive committee here. That's pretty funny, actually. Yeah. So one of the things that's been interesting is we look at, I think now we have 5 ETFs that are over $1 billion in the U.S., active ETFs over $1 billion. And on average, those have taken quite, we know it's going to take some time, but usually 5-6 years, where build a track record, show it to me after a year. Okay, then it takes a couple of years. So, one of the parts that's both fun but also frustrating at times is a lot of times the funds that we launched last year, the funds we're launching this year, those may not be gathering assets until 26, 27, 28, as investors see that it's doing the objective that we stated. So, from the growth strategy, that's our focus right now, is we're really going to beef up the active ETF lineup. We think there's a lot of capabilities within the firm that lend themselves nicely to the ETF vehicle. We're going to keep bringing those out. We're going to let them start building a track record and hope to have those be the next PVAL and the next INCM a couple years from now. One last comment, the 50 was a global number. And so a lot of everything that we've just said, we are optimistic that will happen in Europe as well. And so we're likewise, we're thinking about our active lineup in Europe, where hopefully that active ETF growth trajectory will look a little bit like the US has over the past couple of years.
In terms of beefing up the active ETF lineup here in the US, I'm curious, Where does the ETF share class structure fit into this? As you know, the SEC essentially greenlit that recently. I know Franklin has filed with the SEC to utilize this structure. How do you view that in the context of the firm's overall growth strategy?
Sure. So you're right. We file that as well. We are, we're monitoring the filings. We're thinking through our, potential funds that might have a share class. One of the parts that's interesting is everything I just said was sort of built from a product development pipeline of not having share classes. In fact, we've even had mutual fund conversions with three thus far, and a wide array of municipal bonds coming up later this year. So we're going to watch. We're going to see how the industry uptake occurs, quickly or slowly, and then we'll be smart about which funds we want to add. I mean, there's some flagship mutual funds that we're looking at, but we also have some ETFs that are within that same category. So it doesn't necessarily make sense for us to have now double the amount just because of a share class. And for everything I said about the active strategies, it has to make sense from a performance, from a fee perspective. So we're going to monitor it. Like you said, we have the optionality given the filing, but we'll be more monitoring than pushing forward out of the gate.
I mentioned that I've asked, I think, just about every single guest about the rise of active ETFs this year. I think another question I've asked just about everybody is just how big of a deal do they think the multi-share class structure will be for the industry as a whole? So if we want to set Franklin aside here and just take a step back, I'm curious what you think about that. How big of a deal is this?
I wish I knew that answer. I'm probably more on the I'm not sure it's going to be as big of a deal as others. So maybe on the scale of 1 to 10, maybe I'm more in the middle. Only because of the 300 to 400 billion of growth that's already occurring within the ETF active space. I can't envision it's just going to turn and say, okay, well, enough of those. Let's go to share classes. So I just think that there's such a nice, robust market of active ETFs already. I can't. It's hard for me to picture a world where all of a sudden the share classes just equal those amount of inflows. But I guess we'll see. There's certainly some strategies both at Franklin Templeton and other asset managers that have scale, that have lengthy track records that I'm sure investors would love to see a share class added.
Yeah, I think one of the most challenging aspects here, and I've talked a lot about this, is just the increasing due diligence burden for end investors as more of these products come to market. So to your point, there already is a very robust offering of actively managed products out there. And certainly more choice, I think, is always good for investors. But as we have ETF share classes roll out, it just raises the bar for due diligence for end investors. And I do think for some strategies can be very difficult to differentiate the differences between them. And I think that's going to be one of the hurdles.
That's right. And also there's going to be some mutual funds that don't fit nicely within the ETF construct, with whether it's transparency, whether it's intraday pricing and liquidity of the underlying basket. So like I said, we're going to monitor it, but I think everything you just said, especially when I think about the conversations that we've had with our ETF lineup, comparing it to the existing mutual funds and the differentiation that those gatekeepers like to see, I think it's going to be challenging.
Well, and also, of course, with a mutual fund, you can close that to new investors. And so if you have a strategy that maybe has some capacity constraints, perhaps that doesn't port over very nicely into an ETF. So I think you're right. I think there are a lot of considerations there. Plus, just operationally, I don't know that every fund company is set up on the capital market side to be able to offer ETFs at this point. And working with wirehouses and brokerage platforms, there's a lot that goes into it on the distribution side. Okay, a few minutes left. Because I can't help myself, I think I have to ask you about crypto ETFs. Franklin, of course, offers a spot Bitcoin ETF, ticker EasyBZ, BC. So good ticker. And then there's a spot Ether ETF, ticker EasyET. And there's a crypto index ETF, ticker Easy Peasy, which I think that's my favorite ticker. And I believe you have filings currently with the SEC for spot Solana and XRP ETF. So again, I'll just have you step back. How does crypto fit into the longer term growth strategy at Franklin?
Sure. So, yeah, that was nice job with the tickers. That I get a little bit tongue tied there as well. It's been an interesting conversation with our digital asset team. So we have a whole team that's researching all these coins. They have an on-chain money market fund called Benji, and it's been interesting to think through a product strategy, given that currently there really was only a couple choices with Bitcoin and Ethereum as the underlying coins that could be held within the ETF vehicle. That is all about to change. The generic listing standards that the exchanges have put forth that are now being adopted is going to allow a lot more coins to be held within ETF form. So to your question is, we've almost been kind of approaching this backwards is stuff. I think in the early days of the ETF, where you had hundreds of thousands of stocks, and then you wanted to now pick, okay, let me have an index fund, let me have an active fund, I'll pick a subset. This was almost the opposite, where there's only one or two underlying tokens, and so there really wasn't a whole lot of ways to mix and match that in the marketplace. As that number starts increasing, that'll be an interesting time in terms of what we put within the ETF vehicle, whether it's more multi-coin. Adding the design of Easy Peasy, our index fund, was as regulatory adoption changes and these become permitted, the index will grow to hold more coins. Right now, it still just owns the 2 coins. So at some point, that will be a 5, 10, 15, 20 coin index, which will give a broad exposure. We'll work closely with the digital asset team about what specific coins we would want to have in ETFs as a standalone, just like we're doing with Solana and XRP. And then it wouldn't shock me if down the line active management becomes prevalent for that team to start picking which coins they think would outperform others.
You obviously have a lot of conversations with investors. I'm assuming institutional investors as well. Can you offer anything anecdotally just in terms of interest around crypto? Have you seen more questions over the past year? Has it been the same? What have you seen on that?
Yeah, I mean, the questions are, I think everyone's been watching. Let's just start with Bitcoin. I think everyone's been watching Bitcoin for a while now. And I think at this point, there's just an acknowledgement, okay, what is it you want to see from this asset class about, putting it into your portfolio? And then, okay, well, what's the risk metrics? What's the Sharpe ratios? What's the information ratios? What's the volatility? All of a sudden, it doesn't look that different than a lot of the other, whether it's, growth stocks or AI or other asset classes. And then, okay, so maybe a low single digit percentage makes some amount of sense. Past Bitcoin, the evolution from the conversation we have are specifically why this particular coin. And this is starting to look like more classic analysis of underlying securities. This is, okay, what are the cash flows? What are the prospects? What's the revenue? There's actually, numbers associated with these projects that you can say, hey, here's why we think the Ethereum blockchain is better or worse than the Solana blockchain. And we can have research that shows as such. So I think the conversation is evolving interestingly. It just is, there's still just a natural, maybe tension's too strong of a word, but we've got all this decentralized financial new innovations, and we're bringing it to this now somewhat traditional, fund vehicle. So there's a little bit of, sometimes I'm like, wait, what's this new thing going into the ETF? But I appreciate that investors getting lots of things within the ETF. So it's probably not so surprising.
Yeah, that can open up a much broader conversation if we want to head down that path. I'll just say, to your point on the single coins beyond Bitcoin, I do think that's a good reason why investors may want to look at an index-based approach, something like Easy Peasy as that evolves, or as you were touching on, an actively managed approach. I think it's still so early in the space that if you want exposure there in an emerging category, taking a diversified approach, to me, makes a tremendous amount of sense. But you're right in that, we're taking digital assets and putting them in a traditional vehicle. Some people thought this was going to replace the traditional finance system. So I've always said I think ETFs are a bridge between TradFi and DeFi. But David, such a great conversation this week. I feel like we always cover a ton of ground, which I love. We covered a wide variety of topics here. So thank you for joining me this week.
Likewise. Thanks for having me, Nate.
That was David Mann, head of ETF Product and Capital Markets at Franklin Templeton.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Looking for a new approach to managing market swings? Webb's Defined Volatility ETFs seek to use a transparent, rules-based strategy that dynamically adjusts exposure to equities based on real-time market volatility. The goal to help maintain a specific level of risk while seeking to enhance risk-adjusted returns. Investing involves risk, including the possible loss of principal. Carefully consider the investment objectives, risks, charges, and expenses before investing. To obtain a prospectus containing this and other important information, please visit https://www.websinv.com. Read it carefully before investing. Distributor Foreside Fund Services, LLC. Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company, LLC, FMR.
I'm now joined by Matt Kaufman, head of ETFs at Calamos, who currently offers 41 ETFs, about $1.3 billion in ETF assets. That includes the Calamos Autocallable Income ETF, ticker CAIE. This was the first autocallable ETF on the market, and it's already Calamos's most popular ETF, about $335 million. It just launched in June, so clearly a lot of investor interest here. And Matt is now joining me from Chicago to go in depth on autocallables. Matt, it's always a pleasure. Great having you back on the podcast.
Nate, thanks for having me. 41 sounds like a lot. That's a big number you threw out there.
It is, and it's one that continues to expand rapidly, including autocallables. And I thought, let's just jump right in here. I do have a lot of questions for you around this particular ETF, but I think let's start with the obvious one. What is an autocallable?
Yeah, good question. You can think of an autocallable a lot like a bond. So reframe your mindset from the equity markets to the fixed income markets or the note markets. An autocallable is a lot like a bond that simply pays you monthly income and returns your principal either at maturity of the note or when you're called away. As the name implies, the auto call feature would be that you're called away early, you get your principal back, you get your final coupon payment. So the simplest way to think of an auto call is like a bond that pays income and returns your principal at par as long as an equity underlying doesn't fall too far. So it's tied to the equity markets instead of credit or duration like a bond traditionally is.
And so what is driving that coupon rate or the distribution rate behind that? So if you think of it like a bond, how do I think about the interest?
Yeah, one of the ways to think about this is to frame it versus covered calls. That's a very popular part of the ETF ecosystem. I was fortunate to be at PowerShares in the early 2000s, and we launched the first buy right ETF. I think it was a little before its time. Nobody really bought it back then. It was 2007. It was a little sliver on the bar chart. You fast forward, almost 20 years now, and that buy right or that covered call space is enormous, especially in the ETF world. It's about $150 billion market. So what are you doing, with a buy right? You're selling off your upside, you're collecting an income for that. And then the amount that you collect is largely dependent on a few things, in the options pricing model. It's based off of interest rates, volatility, dividends in the underlying. And so if vol is changing in that covered call strategy, the income level is going to be changing, which is why you see a lot of strategies today, searching for derivative income and using more and more volatile underlyings in order to deliver that. There's risk with doing that, as the risk goes up. So if you look at the structured note marketplace, the reason I started with covered calls is derivative income dominates structured notes as well, but it's done so through the autocallable. So that is not a listed option. You cannot go out to the board options exchange and do option strategies on these types of options. Those are largely bank strategies, which is why it's in the structured note space, but it's a long dated put right strategy. So to summarize that, you've got covered calls in the ETF space. In the structured note world, it's about $100 billion per year. It makes up more than half of the overall structured note issuance every year. This auto-callable space, it's a long-dated put-writing strategy that has a call feature, and so that is largely what's making up, this income. And then the reason with CAIE, you asked about the income level there. The distribution rate has been north of 14% over the last three distributions, and if you look at the coupon of the underlying index that we are trading on swap, it's right around 14.5%, and it's very consistent and stable, about 10 to 11% over the risk-free rate. So if you go back to the covered call analogy, that volatility in the income stream is there. We've eliminated that with the auto-callable strategy, CAIE, and the reason we were able to do that is because we're tied to a high volatility, stable volatility underlying S&P 500 index. So we've taken the S&P 500, instead of just tying your income to the S&P 500, we have a target volatility of 35% for each of the auto calls that are in the portfolio. And that allows for a high, stable coupon. But we need to dive into the actual mechanics of all of these as well. So I don't want to jump ahead of ourselves.
Yeah, there is a lot to unpack there with what you just said. Let me come back again, just to keep things basic here. When you describe the potential benefits of autocallables, is it really the potentially higher distribution or coupon than, say, traditional bonds? Like, why would an investor want to consider these?
Yeah, that's right. The autocallable can deliver a really high income level that's tied to the equity markets. And so a traditional autocallable has features to it. You would have a life, let's say it's 5-year term for an autocallable note. You would have a reference index that you're tied to. The S&P 500 or the NASDAQ 100, if you just did that outright, you wouldn't get a very high coupon for that, maybe something slightly over the risk-free rate. So you tend to tie it to something different. Sometimes you're tied to a worst of basket is a popular term, where you're getting the worst of the NASDAQ 100, the S&P, or the Russell 2000. That might get you 8 to 9% income to do something like that, because volatility, again, is lower usually in those types of indexes. And then the other terms that you want to go through are barriers. So for the auto call, we have a 5-year life. We have a reference index that we're tied to. And there are barriers where if you fall through, then your protection goes away. So let's say you have a 40% downside barrier, where if that index falls by 40% or more, you would lose your coupon for that one particular auto call. And then at maturity, there's a maturity barrier. If that reference index is down by 40% or more 5 years from now, so at maturity, it's European style, then you would have principal at risk in that auto callable. So the reason advisors and investors love auto calls is because you get a high income that's tied to the market just not falling too far. So you're taking on this deep equity market tail risk in exchange for a really high coupon level. So that's why a lot of people use them.
So let me just restate that so everybody's tracking here. So if I were to describe an auto-callable, you're basically giving up equity market upside, but in return, you get a higher coupon payment than many traditional fixed income strategies. But then there is that risk that if there's a severe market downturn, those coupon payments could stop. And if it's a sustained downturn, you could have some principal at risk. So is that how to think about that in a nutshell?
Yeah, it's a great way to summarize it. To give you an analogy, Nate, if you just gave me a $100 bill, or if we use Monopoly money, give me $100 in Monopoly money, and let's say you have a 12% annualized coupon. So every month, we're going to look at that underlying reference index. If it's positive, you're going to get $1. If it's flat the next month, you still get $1. If it's down 30% the next month, you still get $1. And then the next month, let's say it's down 45%, no dollar for you that month. And then the next month, if the market's above that 40% threshold, you start to get your coupon again. So that's how the payments would work for an auto callable like this. And then 5 years from the starting point, if the reference index is down 40% or more, that's when you can lose principal. So if you're down 35%, you're going to get all of your principal back. If the reference index is down 40% or more, you will lose principal by that amount. So that's how an auto callable works. What we've done with CAIE is we've built a portfolio of a weekly ladder of auto callables that all have standardized terms. So again, 5-year maturity, 40% coupon barrier, 40% principal maturity barrier, and you issue those every single week. So your diversification is tremendous here. Rather than having single point timing risk for a coupon, single point maturity risk, if it was 08 and you were down 40% at the end of 5 years, you would have lost 40% of your money. But what if you could spread that out 52 or more times and you had lost 40% on 1/52nd of your portfolio? It's tremendously diversified. So we are seeing advisors, moving from their traditional auto callable structured notes into CAIE. They're calling this the easy button. It's their word, not ours, but I'll take that marketing term. They're saying this is a great way for us to apply this across our client book of business. We can put it in models. One particular advisor said, I fly to New York every quarter. I meet with banks, try to find the right auto callables for my clients. He said, I just canceled all my flights to New York. This is the easy button for me. I can apply this across my entire book, and it makes it really seamless and streamlined.
Going back to, I just want to make sure people fully understand what the risk profile of these look like. And we mentioned this 40% barrier. My understanding is that there is some, what I'm going to call embedded leverage in auto callables, right? That it's not just if the S&P 500, which I'm using as a proxy here, it's not just that if that goes down 40% in absolute terms, the 60% barrier in the auto callable could be breached if the S&P 500 goes down something less than that, right? Because of the vol targeting. Do I understand that right?
Yeah, it's path dependent there. So the auto callables that are inside CAIE, just to give you an overview of how those were put together, we've partnered with JP Morgan. They're our hedge counterparty, a hedge provider. And then also with Mercube, a very well-known custom index provider. So we've leveraged the auto callable pricing model that JP Morgan already has on Mercube US Large Cap Vol Advantage Index. There's about $4 billion of these types of auto calls already in the market in the structured note side. So we built the laddered version of that. We built a laddered index with Mercube that delivers this laddered exposure every week, 52 or more auto calls. I say 52 or more because each one has a non-call period of 1 year. And then outside of that, if the auto call is not above its starting point, then it does not get called away and it stays in the portfolio. So you can go to our website, you can look at our auto callable dashboard and see exactly where every single one of these is trading. So that's the product that we have put together. But again, each auto call, as you said, is tied to a custom equity underlying index that's been optimized for auto callables. So I say it's been optimized for auto callables because it has a high volatility target, 35%, and then it has a daily decrement fee of about 1 basis point or so. That's not a fee that's going to us. It's not going to JP Morgan. What all of that combines to do is optimize and stabilize the options pricing model. So go back to the beginning of our conversation. All of the terms in a covered call strategy are largely variable. And so if vol changes, if rates change, if dividends change, that's going to change the coupon that you're going to generate from a covered call strategy. Well, what if you can stabilize all of that? This has been, in the market for 30 years or more, this idea of volatility targeting. So that's what we're doing with the underlying reference index here. We've targeted a vol of 35%. So to your point, you can see when this might work well. Let's take a COVID example. When the S&P 500 vol is 60, 70%, well, in those markets, you're going to be about half as exposed to the S&P 500. So that is a very defensive strategy from that perspective, where you're actually defending the barrier, and the market would have to fall significantly for you to actually fall by 40%. And then the inverse would be true, where the risk would lie would be if you have a low leading vol environment that drops very severely and sharply. Let's take Liberation Day in April, but then never recovers. And so we actually have not seen a historic environment like that where you never recover. You tend to be, whipsawed or have a V-shaped market like that. So looking at that strategy, that index, MQ AutoCL is the index. Looking at that index that we trade swap on with JP Morgan, historically, you would have not breached any principal over the last 10 years. You would have gotten every coupon over the last 10 years. And the only time you would have lost coupons would have been during 08 and 09, the global financial crisis. And as a result of the drawdown in the GFC, you would have lost about 17% of your principal. So historically, that would have been your worst case scenario, is a 17% principal impairment and largely lost coupons during the financial crisis.
You mentioned that the autocallables here, they cannot be called within the first year, but my understanding is that most autocallables are actually called prior to maturity. Is that right? And is that just because typically over time the market's going up, right?
That's exactly right. Yeah. Okay. So when you launch an auto call, let's say it has a 1-year non-call period, a 5-year life, and 40% barriers, the average life of an auto call like that is about 1.5 years. So you'll exit that non-call period on week 52, and then it tends to be positive. As you said, the markets tend to go up, and then you get called away. Well, if you just own an auto call outright, a lot of times that's not a great feature, because you'll get your principal back, you get your final coupon payment, the trade's over, the show's over, now you've got to find a new auto call. Hopefully there's vol in the market when you strike that, so you can get a high coupon. What we've done is we've solved for all of that. So inside that index, if you get called away in one of those auto calls, the principal gets reinvested at the beginning of the ladder. It's a very evergreen and automated process, and it just continues over and over. And then every week when we strike that new auto call, the options pricing is very stable. And so every week you're going to get about 10 to 11% over the risk-free rate inside that auto call. People might be familiar with insurance type products. Look at fixed indexed annuities. Those will give you a participation rate, but on a low vol index, maybe a 5 or 8% target volatility. When you're doing autocallables, you want the inverse. You want to collect a high coupon. So you need a high volatility target. You ladder that out 52 or more times. You put 40% principal barriers on those. And what you're left with is an experience that looks a lot like the S&P 500 over time, with a high stable coupon. And those coupon payments are highly tax efficient, which I know is a topic we should cover too.
Yeah, I definitely want to touch on the taxation of this. One other question I have, just as I think about potential risks, how deep is this market? Because I'm guessing there are some people out there who might have concerns regarding putting autocallables in an ETF wrapper. Maybe, there being some liquidity concerns if there were some sort of market dislocation. Are there any concerns around that? You mentioned JP Morgan is providing that swap exposure. Could they step away as a counterparty? Just what does the underlying liquidity look like here?
Yeah, the underlying liquidity is based on the S&P 500. So there's a reason that we've built it the way that we have. We have a NASDAQ 100 version coming to market early November as well. But these are based on multi-trillion-dollar equity complexes. So there's a remarkable amount of scalability, of capacity, and liquidity. On the liquidity front as well, One of the main reasons that we built this in a laddered index form, and then we can trade that on swap with JP Morgan, is so that the market makers can really efficiently hedge their positions. So you talk about liquidity in an auto-callable space. It might not be there because you're trading an actual note with a bank and you're taking on the credit risk of that bank. Here, it's a synthetic portfolio of options pricing. And so that translates into a really efficient, really tight bid-ask spread. And then the market makers have access to that index. So they can see that index print every few minutes along the day, almost like an iNav. So there's times we're a penny wide on the ETF bid-ask spread. You cannot say that about a lot of bond funds, let alone an auto-callable strategy. So we've thought through a lot of those components, and we're able to deliver that in a really efficient manner. I would also say that it's largely an improvement over structured notes that you might have purchased in 07 or 08. We get that question quite a bit. I was exposed to Lehman paper or other types of paper in 08, and I don't want to go through that again. Well, fast forward to what we've built here. We've built this back a lot better than structured notes were 20 years ago or so. And the reason is, when you do this on an index and trade it on swap, well, now JP Morgan has to post collateral for the swap. So they have to post variation margin for the swap, post Dodd-Frank. And then Calamos posts about 95% of treasuries are in our holdings. That is the collateral for the fund. So it's nearly 100% collateralized. So we've largely eliminated the credit risk associated with owning structured products. So let's say that JP Morgan goes under. We can play this out. I doubt they'll go under, but if they do, we'll have to find a new counterparty. Might be difficult if JP's under. I'm sure a lot of other banks are too. But what are you left with? You're left with a bunch of treasury bills. So the product will stop looking like an auto call, and you'll have nearly 100% of your money sitting in treasuries. So you'll have instant liquidity there to be able to get out. It's not a subordinated debt structure. You don't have to hope that there's balance sheet money that you can get back. You will literally be exposed to treasury bills.
Earlier, you briefly touched on like equity premium income ETFs or covered call ETFs. And I want to come back to that because I actually think comparing auto-callable ETFs to those is quite helpful just in crystallizing the idea. And as you know, equity premium income ETFs, those have become very popular. And so how should an investor think about your auto-callable ETF compared to an equity premium income ETF? And let's just say a run-of-the-mill equity premium income ETF, not the single stock stuff in the wild, products we're seeing out there.
Yeah, so equity premium income funds are largely covered call strategies. Some of the larger ones out there actually own equity-linked notes, so you do have the credit risk that I was talking about in those types of portfolios. The other thing that we have solved for is the tax efficiency. So a lot of equity premium income strategies will distribute income in a way that is taxed as ordinary income. Some have taken a little bit step above and maybe distribute 50 to 60% as return of capital. Well, in CAIE, nearly 100% of the coupons, about 90% of the coupons, that value is going to be distributed as return of capital. So that's going to reduce your cost basis over time. And then once you've exhausted that cost basis, so if we pay 14.5% coupon, maybe 6 to 8 years from now, you'll start paying long-term capital gains rates on any coupons after that. So it's highly tax efficient. And again, it's the way that we've constructed this, and the tools that are available to us allow us to distribute this income in a way that's much more tax efficient than any of the equity premium income strategies that are out there. But then I would also look at the variability of the income. One of the goals for this auto call strategy is to deliver a high stable income. And so you can see in our dashboard, there's 60 auto calls in there right now, with only about a 75 basis point difference in income between the first one and the last one. And that's largely just tied to the risk-free rate. So the risk-free rates come down a little bit. And so your coupon in one of those has come down a bit. But I would say you have dependability and stability of coupon, tax efficient income. And then in some cases, the credit risk is largely eliminated.
Okay, so autocallables, high stable income, you do have that tail risk if there were severe market downturn. Matt, where does CAIE fit in an investor's portfolio? Do you see this as part of the equity sleeve? Is it part of the fixed income sleeve? And to be clear, we're not here to offer specific investment advice, but just how should investors think about CAIE in the context of a broader portfolio?
Yeah, from an asset manager's perspective, the low-hanging fruit for us, we were doing a lot of work on the structured protection side. We built the first 1-year, 100% protected equity ETFs. And as we were in the field talking, a lot of advisors had said, and were asking for auto calls. I have papers all over my desk. I'm trying to sort through which one is the right one. Can you work on and build an auto call strategy? This had been on our minds for several years, but that was who we initially built this for. There's hundreds and maybe thousands of advisors who already use auto callable notes, and this was an easy transition for them. So we've seen a lot of that money move over already. There's about 10,000 investors in CAIE. So that was the initial place. But where those folks are using auto calls is largely for income generation, and they're pulling from equity markets in order to do it. So the volatility profile of CAIE is a lot like the S&P 500, about 18% volatility over the last 10 years. So you're keeping and retaining that S&P-like vol profile, but exchanging that for a high stable coupon. So we want to make sure people are not moving out of safe bonds or cash. This is not that. This is an 18% volatility over the last 10 years. Again, so you want to be cognizant of that. Some folks are making a correlation to high yield bonds, looking at 2008, the default risk of high yield bonds there, and saying, okay, I'm exchanging that for some deep in the market, in the money tail risk. So that would be some of the ways that people are thinking about it, but largely equity replacement and occasionally a high yield bond replacement.
We both mentioned the strong investor interest already around CAIE. On the heels of that, I saw that Calamos has a second autocallable income ETF in the hopper, right? Set to launch this quarter, the Calamos US Tech Autocallable Income ETF, ticker CAIQ. Can you tell us anything about that?
Yeah, so we have CAIE and now we have CAIQ coming, the NASDAQ 100 version. If you're a follower of derivative income strategies or buffered strategies as well, you tend to do the S&P 500 version first. A lot of the market flow goes to the S&P 500. Well, next in line is the NASDAQ 100. That takes in a lot of market share as well. People tend to move toward the NASDAQ 100 in derivative income strategies because the NASDAQ has historically exhibited a slightly higher volatility. And so again, people are looking for that step up in coupon. When you stabilize the S&P vol around 35% and you put these barriers, you can surmise you could essentially stabilize the price of beans around 35% and still get the same income. So what we're doing with the NASDAQ 100 is we're stepping up the barrier slightly, and that will give you a little bit higher of an income payment tied to the NASDAQ 100. And interestingly, even that index going back through the financial crisis had never breached its principal barriers. So even at a 30% downside barrier, you would have never breached over the financial crisis. So some interesting dynamics. And I know it's because the NASDAQ 100 has recovered swiftly historically. And so this is an opportunity for people to get that broad tech exposure. People are really loving that type of exposure right now and get a high stable coupon in exchange for that. And then again, if you take that laddered index approach, you diversify your risk out over 52 or more checkpoints. You got a really high stable coupon, and the risk of breaching that barrier is remarkably low. The one thing that we didn't touch on is, those since they're bonds and tied to the equity market, they will trade at a discount. And so if the equity markets are going down, I think of it like 52 rubber bands. They'll start to stretch down and trade at a discount. As long as those rubber bands don't snap, the barriers don't snap, you'll go back to par. either when the market recovers or as you go toward maturity 5 years from now. So you talked about capital appreciation. That would be when capital appreciation would be there. So if you could buy these at a discount to par, you're going to get that high coupon plus the capital appreciation rebound. And you can see that again on our website. Look at the dashboard we've built. You can see every day whether the portfolio is trading at a discount to par, a premium to par. Like, we give you a remarkable amount of information to make decisions on.
Matt, just a few minutes left here. As I know you're well aware, and actually we touched on this with the equity premium income ETFs, but there has been an absolute explosion of yield-seeking or yield-enhancing ETFs coming to market. And it does seem like the complexity of those products is significantly increasing as well. And I'm just curious how you think about investor education around a product such as yours. And I think you've done a fantastic job of describing everything here today, but it can be complex. Some of these terms investors may not be familiar with. You have to do your homework. And so I do think this is a challenge for investors. So just how do you think about education around a product like this?
Yeah, I think the financial markets in general are complex, especially when you move into derivative income strategies. We've taken a lot of the complexity and built it into the underlying, and then built a single index print on that we can then deliver, the certainty and the high stability of that income. So the outcome is very simple to understand. If you look at the equity premium income space, it's a $150 billion market with a lot of complexity built into it. You look at equity linked notes that are not that transparent. Those are issued every quarter or disseminated every quarter with not much info as to how those are actually constructed or what's in it. And so from Calamos's perspective, transparency is of the utmost importance. We want people to be able to understand, if they want to, exactly what's going on under the hood. So again, we've built a dashboard, which is patent pending as well. Hopefully we get that done. But it shows you the position of every single auto call, where it's at relative to the reference index, relative to the maturity barrier. So you don't have to guess. You don't have to wonder, am I at risk? You can actually see it. You can see it live every day. So that's our goal. We want to give people a tremendous amount of transparency. On the derivative income side as well, what makes me a little nervous in that space is a lot of people will build product that have a high coupon amount that you'll never actually be able to achieve, or that will dip into your principal in order to achieve it. And so it's no good if you're just giving people their money back and calling it an income payment. That is disingenuous at best. And then you look at a lot of like daily covered call products that might show a 100, 200% yield. The way that you get there is by taking that 1 day yield. So if markets are volatile today, you get a high income today, and then you annualize that out, and it looks like a really massive number that you'll never be able to achieve. And so those are things that we avoid at Calamos, and I would hope that investors would do their due diligence as to what's under the hood. With CAIE, the strategy that we're trading on swap has had no NAV drag over the last decade. So we've built this extremely well. We've thought through all of this for over the last several years, and partnered with some of the best groups in the world, biggest bank in the world, to be able to deliver this really efficiently to investors. So that's our goal.
Well, Matt, excellent job describing everything here today. Congratulations on Calamos pioneering this autocallable ETF category. Certainly wish you continued success moving forward. Thank you for joining me this week.
No, I appreciate it.
That was Matt Kaufman, head of ETFs at Calamos. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by one of my favorite ETF analysts and experts, Anikit Ulal, who is head of ETF research and analytics at CFRA Research. We're going to discuss ETF trades that did and did not work in 2025. And then we'll also find out which ETF stories most have Anikit's attention right now. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.